So, welcome to Market in a Minute. I've got some advice for Ryan Day, the coach of the Ohio State Buckeyes. If you have a beat up offensive line, you can't run up the middle. You got to throw the ball deep or you got to run around the edges. Tennessee has a really good defensive line. That should be the game plan. You're welcome. Okay, so we don't think that the market's narrowness can keep rolling like this. It's got to rotate. And I think as soon as the calendar changes, you're going to see a big rotation. You're going to see some profit taking in some of these momentum names. The Federal Reserve is going to guide down, basically. They're going to change their guidance. So, what if NVIDIA would guide down? Would the stock go down? So, what if the Federal Reserve would guide down? Would the market go down? May not initially, but that's not a positive thing when they take out some liquidity. And then we can see the seasonality in the tape that's happening. We can see it. It's obvious that certain stocks are going up because they're going up because it's the end of the year and that's where everybody has their money. And then the rotation typically occurs after the first of the year. That's what we're currently seeing, and it's pretty massive. So stock market update. So this is interesting. So since 1950, there's been 8 times where the S&P has gained 20% 2 or more years in a row. And in 6 of those years, so 6 of 8, the third year has been positive by about 12%. So it's likely not going to be a horrible year next year. I bet there's a lot of volatility, and I bet you have to make your money early whenever that when the market's going up. You can't wait around because I believe the market's going to pull back nicely at some point next year, and maybe in a big way. But the average return has been about 12%. In the 90s, there were 5 years of up 20% or more. And then obviously we had the bubble burst and we were down about 50% from where it peaked out at. We're not in that sort of environment, but certain sectors of the market, we're not far off. So the largest 10 stocks account for 36% of the S&P 500. This has never happened before. The market's never been this concentrated. And I want to give you an analogy. It's like being the oldest person that's ever lived, right? Well, that doesn't last very long, does it? That's not something I'd want to be as the oldest person that's ever lived because I know I'm not going to be around much longer. So only 31% of the stocks in the S&P are outperforming. That is so narrow. Animal spirits are running high, really high, and for maybe good reason. Trump's quote golden age, his policies are really favorable. So we do see a big shift from all this federal government spending to get cut, and then the private sector to pick up the growth. And that transition will happen in 2025. Now, the Federal Reserve, they're kind of stuck. We might have weaker economic growth sometime next year when they cut back on all this federal government spending. That's probably likely. And then we'll kick in on the private side. And so the Federal Reserve kind of can't do anything until that inflation moderates more. We're running inflation at 2.7%. So it's too hot. The Federal Reserve is going to cut rates on Wednesday down to 4.25% on the low end of their range, 4.25 to 4.5. And currently the 2-year Treasury is 4.23. So we think they're roughly in line with where the market's thinking. So if the Fed expectation is for 4 cuts next year, and they now come out on Wednesday and say, well, we're only looking for 2 cuts. So that's a disappointment. I don't think the market's going to be overly surprised by that, but generally it's going to take some liquidity out of the economy, out of the markets over time. So that's not a real positive. So we view that as a negative. and how they spend that is going to be really important. So this is viewed as a hawkish cut. I mean, they're going to cut, but it's going to be more of a, looking to not do a whole lot in the future. And then I think this is appropriate. The risk right now is that inflation doesn't go away, maybe it picks up, and the Federal Reserve's back to raising rates again. That's a legitimate risk that the markets should be focused on. Biden has been spending like crazy. I mean, they're going to make sure that that cash register is completely empty before they leave. So that's why the economy partly that looks so strong right now. And then Trump has so much work to do. It'll be interesting if he can claw back some of that spending. The markets are very expensive. So everybody points back to, well, it's not as high as what it was at the very peak of 1999 and 2000. Well, that's true. It's not as high, but it's pretty darn high. So at the peak in 99, 2000, it was 25 times forward earnings. Now it's 22 times. The major difference between now and then is that there's a lot of stocks, high quality stocks that are trading very cheaply. So we're starting to see this rotation. We really started to see it. This is a 6 months chart of the Russell 1000 growth in blue and the Russell 1000 value in red. So you can see that the rotation to value has underperformed quite a bit. It kicked in, over the last 6 months. It really kicked in, and then you had the rotation back from value to growth. It's massive rotation. Now growth has really overtaken value. So at the beginning of the year, we're going to see a lot of selling, of taking profits, and those names that have really lagged, that are negative. People are taking tax losses on them. They're selling those to harvest those tax losses. And so you're not going to take your gains likely until next year. So you have a longer period of time to have to pay your taxes, right? So as we shift the calendar, we're going to see those stocks that have really gotten beat up because of tax loss selling start to kick in, and then those stocks that have been overinflated because of the momentum in the markets and nobody wanted to sell them until end of the year are going to start to roll back down. So we see small caps having a big spike early part of next year. We want to be positioned for that. And then healthcare has dramatically underperformed the overall market. Some for good reasons, some not. And we think that's set up to outperform next year. There's a little bit of cloud over the group because of RFK coming in, but we don't think there's any bite to it. We think he's going to cause a lot of positive things to occur. But in January, there's the big JP Morgan Healthcare Conference, and that usually drives stocks up. Keep in mind, there's some really interesting announcements to come. Avanex is going to report their quarter next week. AVXL, right? They're going to report their quarter next week. They're going to probably talk about a lot of really positive things that are occurring. And they're going to present their data at the JP Morgan conference. Now, when I saw their data at a conference earlier this year, I was blown away by it. I was really thrilled. So I think you're going to see some of these reactions to these small cap companies that are going to talk very favorably about what's going on with their companies, really react in a big way come after the first of the year. So let me just show you the chart on healthcare. Down 13% from the recent high. You would think we were in a bear market. When does healthcare really underperform that by that much? It really doesn't. So it broke through the 208 moving average. It's in a downtrend. We think it's probably bottoming out here. So we think that this is an ideal place to put some money in for a move next year. Iran, okay? Iran has a hit out on the President Trump. So knowing how Trump thinks, we don't think Iran is going to be selling any oil anytime soon after he gets in office. So I would assume that there's a plan for regime change in Iran. Um, I think there's going to be a lot of problems ahead for Iran, and cutting off, potentially 2 million barrels a day out of the supply. I think that temporarily pops oil prices, and again, you can see oil, the energy group, down roughly 10% from the recent high. Again, it got rotated out of. Um, this is back here where we liked buying the stocks, and here's where we kind of moved away from the group, and I think we're getting back here to a support level. Again, a really interesting sector of the market to focus on. Lots of good companies there, and we think that the bias for energy prices. I know Trump wants to increase production, is to the upside in the near term. Uh, so I think that Trump is extending an olive branch to China. And what's been hurting the material sector is the weakness in China and also the housing market. I don't think either one turns in a major way anytime soon, but the chemical stocks are so undervalued now based on their normalized earnings. So Dow Chemical, as an example, is barely making any money, where that the normalized earnings might be $8 to $10 a share. You put a 10 multiple on that, you got an $80 to $100 stock, and the stock's at 40. So you can see how there's value in other places of the market, really good value in other places in the market. Quantum computing. Now, back in the day, that this is the 80s. One of my first stocks that I picked up as a portfolio manager slash analyst at the firm I was working at was Cray Computer. It was a supercomputer at that time, probably the same, it would run the same way as your PC would run currently, but super fast back then. Um, we think that quantum computing is the next big movement in technology in terms of it competing with AI. If you can run quantum computing off your computer, off your chip, that would just be extraordinary. That's not going to come anytime soon. It might be 20 years from now, but Google seems to have an interesting product. Maybe it comes sooner than expected for some limited applications. There's probably all sorts of flaws in that chip, but for limited applications like drug design and development, this could really be a huge leapfrog in how fast they could design drugs. So thank you very much, and just keep in mind if the market has a lot of risk to it, that there's certain sectors of the market that have compelling valuations. It almost reminds me of being at the bottom of a bear market. The valuations are so extreme. We love small mid-cap stocks for next year. We think there's going to be a rotation, and we think that there are other technology names that we can buy. Next week, I'm going to talk about a whole list of really good companies that we've been looking at and that we're putting in the portfolios. So take care. Root for the Buckeyes on Saturday.